Hello. We're continuing our series to help you evaluate your options when choosing a home loan that fits your needs. Over the next few minutes, I'll discuss whether it makes the most sense to choose the mortgage with the lowest or even no closing costs. Don't forget that in addition to paying your down payment at closing, money will be due for things like taxes and homeowners insurance, whether you are buying or refinancing a home. And this amount can be significant, depending on the type of mortgage you choose. In fact, some lenders even advertise a no closing cost mortgage, but don't be fooled, there's no such thing. Before we evaluate this option, let's take a look at what makes up standard closing costs. Lender fees include origination, discount points, processing, underwriting, and closing, and third-party fees like credit report, flood certification, appraisal, final inspection, attorney, pest inspection, title insurance, title search, closing protection letter, deed recording, survey, mortgage-related taxes, and private mortgage insurance. It's quite a list, and keep in mind, this list isn't comprehensive. There are many specialty loans or property types that may have additional fees. It's also important to note that all lenders are required to pass through third-party fees with no markup. In other words, while lender estimates may vary, all third-party fees included in your final closing costs are what the third parties actually charged. So it begs the question, if third-party costs must be passed through, how does a lender offer a no closing cost mortgage? They're simply quoting an above-market interest rate that will generate additional income when the loan is sold. This allows them to issue a large enough credit to cover some or even all closing costs. And in reality, you're still paying the closing costs through a higher interest rate on your monthly payment. Let's take a closer look at an example to see how a no-cost closing loan works. So, let's assume a borrower is financing a $250,000 mortgage with an estimated $2,500 in closing costs, and today's current market interest rate for a 30-year fixed-rate mortgage is 4.5%. Let's also assume that a higher interest rate of 4.75 pays an additional 1% premium to the lender to finance the closing costs. Remember, any interest over 4.5% is considered above market, giving the lender additional premium or income, which is credited to the borrower to cover the $2,500 closing costs, hence a no closing cost loan. But does this make financial sense? It depends on whether the extra interest you pay each month exceeds the $2,500 closing costs. Therefore, it depends on how long you plan to keep the existing loan. To calculate this break-even, you take the difference between monthly mortgage payments at the market rate of 4.5% and the premium rate of 4.75% and divide it into the $2,500 lender credit. In our example, a no-cost closing cost mortgage makes financial sense only if you plan to keep the mortgage for up to 66 months, or 5.5 years. Any longer than that, and your higher interest rate is costing you more than the $2,500 closing costs would. Of course, there are also other ways you can pay your closing costs. When purchasing a home, one of the most popular ways is to increase your offer price in return for a credit from the seller to pay the closing costs. This is just another form of financing your closing costs, this time by increasing the loan amount instead of increasing the interest rate. You could even choose to utilize a combination of both an increased rate and seller-paid closing costs. If you would like to determine if a low or no closing cost mortgage is best for you, your PrimeLending home loan expert can provide a detailed analysis comparing this option to others and answer any questions.